to the slides. Well, first of all, thank you so much for everyone joining the CREA's webinar regarding, how to boost the real estate investment cash flow through commercial real estate by, by exchanging 1031 exchange and also the right leverage. So at the CREA is stands for Chinese American Real Estate Association. We are a nonprofit organization to promoting the Chinese American and Asian American real estate professional try to collaborate and to build a stronger society through both residential and commercial real estate professionals. And I also want to give the special thanks. So I'm the current vice president of the organization, and also we want to give the special thanks to our corporate sponsor of our X, Bank of America, PNC Bank, ABC Capital, Wells Fargo, and US Bank. Yeah, let's just dive right into. So we have, as you guys see on the flyer, we have three of us presenting today. Yuan is the commercial real estate broker. Wei Ming is a 1031 exchange specialist, and I'm the commercial real estate mortgage broker. So we want to kind of give you guys the full, hope this turn into a very informative presentation to see there's an alternative route for the investor or your clients are kind of right now not so happy with the low cash flow from your rental properties. Yeah, let's kind of do you want to take over the control?
Yeah, thanks, Jason. I wanted to, thanks for everyone that's joining us today. Hopefully, I think, some of you guys probably, know about 1031s, and some of you probably know about commercial real estate as well. Hopefully we could just, give you a little bit more education on, what we're kind of seeing. And I guess like right now is the timing is actually what we call kind of like the perfect storm in a way. So that's why we wanted to bring this subject up and kind of go over, what we're about to share with you. So I just want to give a quick overview about myself. My name is Yen-Sing Chang. I've been in commercial real estate since 2001. So I've been in it for 23 years. Always been doing commercial real estate from leasing to representing tenants side, the landlord side. We've also do purchase and sales of commercial real estate. And so right now I've, past president of CREA as well. I'm currently a board member. And yeah, so that's a little bit about myself. Let me see if I can get this to change the slide. Do I have the, okay, there we go. A little bit about our company, Intero. As you guys probably know, that Intero has, it's a big residential brokerage firm in the Bay Area. We're currently owned by Berkshire Hathaway. We do have a commercial division, and this is kind of a team right now for our commercial division. So we're growing. We have a lot of good people on board, and Matt Hagar's are the manager for the commercial division, and some of these people in here I also work with as well. Our company, yeah, combined experience, I think it's more than 200. It's probably like more like 300 years of experience. But yeah, we've been growing. I think we've gotten awarded, CoStar Power Rewards as well. And so we're, big players. We've done, numerous transactions, done some really big deals as well. But we also do, the normal, like a standard lease deal to, a $50 million like sales transaction. So we do pretty much all of the different aspects of commercial real estate. One thing I kind of want just to get out there is that, what is commercial real estate? Commercial real estate is basically anything that's not residential. So you have retail, shopping centers, industrial buildings, land, office buildings, multifamily, obviously more than 4 units, and also business sales. So that's what pretty much commercial deal, what the commercial properties entail is everything but residential. So today, what we really wanted to, I don't know who's listening, but if you're a residential agent, one of the things that we're trying to educate you is that a lot of your clients have obviously own residential property. Most of them are probably their primary residence, but what a lot of people don't understand is that a lot of these investors also own rental properties as well. So not only do they have their own primary residential home, they have residential properties that they rent out. And so one of the ways that we can hopefully educate you today is that, you know, besides just selling their primary homes, is also reach out and say, to ask them if they have any residential rental units as well and how those are performing and, kind of get a feel of what they are, you know, what are the pluses and minuses? Because what we're seeing a lot is that a lot of the residential rentals right now are obviously there's a lot of tenant rights. And so a lot of these landlords now are getting a little bit frustrated, especially through COVID and everything. And so a great way to generate a referral is to see if they have these residential rentals that they're willing to sell, because as we go into this presentation a little bit more, you'll see that there's definitely some upside if they are open to going out of the area.
So let me see if I can, I think I click this and share
Okay,
the video.
perfect.
And let me see if I can.
He's worked hard and owns several residential investment.
Hold on, let me just kind of make it full screen and make sure everybody can see this video. All right, let me know if that works.
Mary has worked hard and owns several residential investment properties. Between repairs, maintenance, late night phone calls, and tenant turnover, Mary spends a lot more time on her passive real estate investments than she would like to admit. With never ending headaches and uncertain income, Mary wishes there was a better way. If only there was a way to own a higher quality asset and get a better return. Meet Mark. Mark used to invest in residential property until he discovered single tenant net leased properties, or STNLs. Mark did a 1031 exchange and transferred his equity from residential property into a cash generating machine, all while deferring his capital gains tax liability. Now, Mark enjoys truly passive income with long-term leases, no maintenance responsibilities, and guaranteed rent payments by corporations such as Walgreens, Starbucks, and the U.S. government. This allows Mark to live life while collecting passive income several multiples higher than his residential properties generated. At the Asia Group, we are uniquely qualified experts in this exact type of real estate transaction. We help you through the entire process from start to finish, guiding you with an unrivaled level of expertise. We utilize a nationwide network of 1031 accommodators, attorneys, lenders, inspectors, and more to ensure your hard-earned investment is in a protected network. We leverage our vast broker network to find you off-market properties for sale that are not available to the public. If you'd like to ditch your high-risk, high-maintenance residential investments, reach out today for an in-depth analysis of how to supercharge your real estate returns while simultaneously insulating your portfolio against future economic risk.
Awesome.
Awesome.
Thanks, Jason.
Yeah, let me get it back to your slides.
Yeah. Yeah, so that's just a kind of real general overview of, STNL. STNL stands for single tenant net leased properties. Obviously, it doesn't have to be single tenant. A lot of these commercial properties do have multiple tenants as well. But most of the ones that we've seen, catch for our, let's see, is it to me now?
Yeah.
Jason? Okay. I can't get it. Okay, there you go. So yeah, that's what it stands for, single tenant net lease investments. So here's a kind of like a comparison chart. We compared single family residential home to a single tenant net lease investment. as you can see, the cash flows typically, we'll have a better chart regarding the cash flow on this on the next slide. But, as you can see, the percentage typically is higher for a commercial. Average lease length as well. Residential is typically a year. Single tenants, I would say more, it's 10 to 15 years. But usually it's, long term. Another lease guarantee, usually it's just personal for the residential. The single tenant obviously is going to be corporate guaranteed, like Starbucks or Dollar General or like CVS. Rent increases. Typically, your residential, you're kind of just going by what the market is at the time. For the single tenant, typically we have fixed increases that's already spelled out in the lease. 1.7 to 2% is I feel is a little bit on the lower side. Typically, we try to negotiate between 3 to 4% annual increases. And then as you see here, expenses, for residential is typically, the landlord's responsible for, like the roof, or, sometimes they do the landscaping, anything breaks that, they're kind of responsible for. With single tenants responsible for all those payments as well. A lot of people don't realize that, but the property tax, obviously, with the residential single family, is the landlords, they pay that property tax. Can you imagine if you can actually transfer that property tax payment to the tenant? Well, that's what commercial real estate, these investment properties have, is that they are all based on what we call a triple net lease. And what that means is that the property tax, insurance, and the common area maintenance are all paid by the tenant. And so your actual gross, rental income is pretty much your net income. And last but not least is the tenancy laws. Right now, as everyone knows, especially in California, the tenant rights have gone like extremely out of hand. And, I've had, family and friends who have rental properties, and, they haven't even gotten paid like in a year, over years, during the whole COVID, situation. So with single tenant, if they're not paying, you basically can just pretty much evict them, and then find a new tenant. So that's kind of a quick comparison chart on the different items for these. Single tenant, these are the kind of different types of tenants, like Chick-fil-A, AAA, all these. We've done deals with all these types of tenants. And the great thing about this is that, like Starbucks, I do leasing for the Cupertino Village that Kimco owns. So we used to have a Starbucks there right on the corner of Homestead and Wolf. And Starbucks had a lease, and they opted to not renew their lease, but then they had 2 years remaining on their lease. They decided to just completely close down. But because they're Starbucks, it's a corporate, entity, they had to continue to pay that rent until the lease ended. So they paid their lease all the way, for 2 years without even operating inside that space. So that is the, huge advantage of having what we call a corporate guaranteed lease. So this is a really cool kind of like comparison. This is what I was talking about, especially with the cash flow analysis. So, as you know, like in the Bay Area right now, a $2 million house is nothing, right? And so a lot of, this is actually a case study. I have a client, they were retiring. They have a rental property in the Bay Area. I think it was worth, just around that $2 million mark. And they were renting it for about $6,000 a month. So if you look on this whole side of the landlord had to pay the property tax. They actually paid an offsite management fee. They had some repairs and maintenance. Sometimes that's actually a lot more. And then the property insurance. So, $6,000 a month, you're thinking in your head, okay, I'm getting $6,000 a month, but after all expenses, you're really just getting $4,000 a month. So $4,000 a month for a $2 million property. So what they ended up doing was that they sold the property, and they've owned this for a long time. So there wasn't, a lot of loan on it. I think it was actually free and clear. So they had, they could sell this, and they basically told me that, you know what, they didn't want to deal with people calling. Well, they had a management company, but still they would get calls from them. It's like, are we approved to like do this expense or fix this and everything? And then so what happened was is that they wanted something where they just completely did not want to even think about it, right? And they were open to going out of the area because you'll definitely get a better cap rate for out of the area. And so what we found them was this urgent care facility in Louisiana. And so same thing, $2 million value. The rental was 130,000 annual, so that's about 11,000 a month, right? And so now because it's a triple net lease, that tenant is paying the property tax, the repairs and maintenance, utilities, all those expenses are paid by the tenant. And so your net income on that would be the 130,000. So with that net income, with a value, that was a 6.5 cap rate. 6.5 cap rate in nowadays is actually pretty good. That's still, I think you can still find some even better deals, but that was because it was a long-term lease. I think this was a 15-year lease with 2.5% annual increases. So they actually have built-in increases every year for this property. So instead of taking home 4,000 a month, now they're getting close to 11,000 a month. And so not only did we went over double their income level, and they're pretty much guaranteed for the next 15 years. So this is what I'm talking about, the perfect storm right now. And the reason is because, especially in the Bay Area, residential homes are still very, very hot. The prices are extremely high. However, the commercial market, because of interest rates, the cap rates have also risen as well. So right now, you can find really good deals. Before, a Starbucks would be a 4% to 4.5% cap rate. Now you're looking at 5.25% to 6% cap rates. So basically, you're doing what the economists say is sell high and buy low, and that's exactly why we call this the perfect storm. Is because if you own a residential home in the Bay Area right now with a lot of equity, and you sold that, and you buy something a commercial property with good returns, is doing exactly what we're doing, is basically selling high your residential house and then buying low, because for the commercial right now, we're at a low point because of the interest rates. What this is basically, so what we're doing is basically helping you guys to hopefully get more listings, because this is another tool for you to talk to your clients about, is hopefully helping them diversify their portfolio. So how this would work this is a 1031 exchange. You defer the taxes. It's 100% ownership of real estate, not a company, and it's nationwide. What it's not is, it's not a partnership or Delaware statutory trust. For the basic requirements, we always say 750K equities, because anything under that, these commercial properties, it's hard to find the corporate guaranteed type of properties. Actually, I would actually even bump that up to $1 million is probably a better number. And so that's kind of like the basic requirement. So if they have like good, about $1 million in equity, that would probably be the best case scenario. Financing, it's based on the building pretty much, and Jason will get more into that as well. And what is this for? It's these residential, these investors that have owned these homes for a long time, and they want to retire and just make sure that they have a check coming in every month and they don't have to worry about anything. Some of these lease deals have even the property taxes the tenants are paying directly to, for these property tax. So the landlord's not even paying it, and then billing them. They're actually just paying them directly. So completely what we call these are mailbox checks. You literally every month you get a check in the mailbox. And then we talked about this before. This is kind of like the best time. It's the perfect storm right now. And then obviously, if you guys, hopefully you guys can get more listings. And the reason why, hopefully you guys, if, need help with finding these commercial properties as well, and you bring us on, obviously we pay a referral fee.
So yeah, I think we can take some questions after each presentation, and I have enabled the Q&A session, or for the participants. I think you can try to type up your question in the Q&A. I don't. Let me just double check. Maybe you have the option to unmute yourself. So let me check. Or you can put in the meeting chat about any questions you have for Yan. So actually, I have a question, Yan. So for the commercial real estate, there are, as part of the tenants you're listed, there are, some of them, the quick service restaurants, which is sometimes not corporate, but like franchisees. What
Correct.
kind of the, size of franchisee it will be ideal, or kind of you feel it's safer to kind of bring the tenants in? I saw some of the requests are kind of have a franchisee has only got, 3 stores, but I heard like people are, the lenders are, in my point of view, is wanting to deal with franchisee with at least 30 stores. So want to hear from you. What's your point of view?
That's actually what I was going to say. It's 20 to 30 stores minimum, because and it depends on how they hold them, right? I mean, if they're all in separate entities, that they can still close one down. So, but if they have that many locations, then at least they're experienced, and they know what they're doing. So yeah, I would say about like 20 to 30 locations.
Got it. And I have another one is have you dealt with any kind of single tenant at least kind of at the time of um lease maturity? And are they typically extending, or have you run into kind of the releasing some of the retail store situation?
Yeah, so that's actually interesting because so we actually did a deal for one of the founders of Intero Real Estate, Gino and Tom and those guys, and they sold the property. They got it. They ended up buying a DaVita dialysis center,
Mm.
and they've had it for a while, and so they're thinking of selling it. And so what we've done was that, and a lot of people don't realize this, is that you can actually reach out to the tenant and see if they will extend their lease to put it back on the market. Because if you have 3 years remaining on the lease, it's not going to be as attractive compared to someone that has 10 years left on the lease. So we were able to renegotiate, basically, give them basically extend the lease, right? And maybe there's a small, concession that you give in or something. But that is a possibility where, and that's how a lot of people do ask, what happens after 15 years, right? And then that's also something you really want to look at is what kind of property, because a dialysis center is very specific, right? If they do leave, that's a very very specific type of use. I mean, it's 6,000 square feet, so it's not like no one's going to lease it, but it is a very specific build out. And so to find another dialysis center, or it could be a preschool, you don't know, but that does take time to get those kind of permits. So you do want to kind of look at what kind of properties these are. I tend to like quick service restaurants because those are really easy to lease out. Food's always been easy to lease out, and so especially if they have drive-throughs.
Yeah, cool. So actually, for the audience, since we have a smaller group, I kind of enable everybody can unmute themselves if you want to join this discussion. Yeah, if just curious if anybody else has any questions. If not, I can pass along this to Wei Ming, who's our 1031 exchange specialist. Let me get. So hang on, Wei Ming. Let me just give you the remote control. Yeah, you should be able to control that.
Okay, let me see if I can do this. Oh, perfect. Thank you very much, Jason. Hi, everybody. My name is Wei Ming, and I'm one of the principals of Excel 1031. We are a 1031 exchange company, so the only thing we do is facilitate 1031 exchanges. Now, before anybody asks, we don't offer escrow services. We are not real estate agents, so we do not help clients sell or buy their real estate or to look for replacement property as well. We are not CPAs, we're not financial advisors, so we can't speak on your specific taxes, but the information that I can provide, they're more general, right? They can give you a good idea of what you might be looking to owe in taxes or how much taxes um, you could potentially incur. But without further ado, I'm going to go straight into 1031 exchanges. Now, that was the disclaimer that I was just talking about, not a CPA, not a financial advisor, but I want to dive straight into a 1031 exchange. And just like Yuan said earlier, 1031 exchange is a tax deferral strategy. This allows you to defer up to 100% of your capital gains taxes when you sell your investment property. Now, let me dive into that a little more. A lot of investors, a lot of real estate agents, even, they will often hear that, oh, I need to sell an investment property in order to do a 1031 exchange. When in fact, any portion of a property that's been used for business, investment, or trade use will qualify for a 1031 exchange. Do you rent out your ADU? That portion of your property qualifies for an exchange. Do you rent out the bottom half of your house, your top half, your other 2 units, if you live in a multi-unit property, your top unit, bottom unit, whatever portion that has been used that way, um, you can 1031 exchange that portion. So think about that, right? Because this allows a lot of investor to potentially plan ahead. Now, if you are an investor and say, oh, I live in my property right now, my profit, my gains on this property is over $500,000 if I'm married, over $500,000. How do I plan ahead so that when I sell this property, I may not have to pay any capital gains taxes? How do I defer all those taxes? Well, I'm just going to leave you with that question right now because I'll explain that in later on in my slides. But I do want to quickly go over some of the reasons why we do an exchange. Number one, a 1031 exchange allows you to defer up to 100% of your capital gains taxes. And just like Yuan said, it allows you to diversify your portfolio. You can sell your residential property and buy commercial property as well. If you have the money, you can buy one commercial, maybe another residential. It's up to you how you want to split that up. You can buy properties that you can manage yourself and hire a manager if you want to, or you can get into single tenant net lease properties all the way up to triple net properties. All right. I'm sure everyone will be able to answer a little bit more about that. That's more in his wheelhouse on what the differences are. But those are commercial properties where the tenant is taking care of a lot of those smaller items like toilets, the trash, the things like that. Now you can also get into DSTs, Delaware Statutory Trust, so that you can be a hands-off real estate owner and all you're getting is that monthly check. Now, a 1031 exchange is also a great way for you to increase your cash flow and buy like kind property. Now, when I mention like kind, that means that you can buy real estate anywhere in the United States and it can be any type of real estate. Now think about that. If you have a tenant, I'm sorry, if you have a property with a tenant that's not paying you rent, maybe it's time to sell that property and to get into another property that's going to get you, or you can screen for a better tenant or get you a better cash flow. Another reason to do a 1031 exchange is depreciation. If you have owned your property for a long period of time, you may have uh, depreciated your property a lot, or you may have fully depreciated your property. By doing a 1031 exchange and buying additional equity properties, you can take that additional equity and depreciate that. Last but not least, we have passing on wealth. A 1031 exchange is a great way to pass on wealth to future generations. Now, when you do a 1031 exchange, here's basically what you're doing. You're telling the government, I owe you this much tax money, but I'm doing an exchange. So I'm going to use this tax money to buy myself more real estate, better real estate, and just more expensive real estate as well. Now, when I pass away, when I kick the bucket, I may have accumulated a bunch of capital gains taxes. And you know what? That passes away with me. When I pass away, all the deferred taxes I have accumulated in my lifetime, that passes away with me so that whoever inherits my properties, they don't have to deal with the deferred taxes that I have accumulated. It could have been hundreds of thousands of dollars or even millions in my lifetime. Think about that. You don't have to pass on this burden to whoever inherits from you in the future. Now, one of the biggest mistakes I often get when dealing with 1031 exchanges is a lot of clients will often do a Google research. They will find that, oh, Wei Ming, I'm finding out I owe 15 or 20% in taxes. Is that true? The answer is it could be, yeah. But I typically tell my clients, you're probably closer to about um, 30%, 30 to 33%, it's probably your average. The reason why is when people talk about capital gains taxes, there are four taxes involved. There is depreciation recapture, federal taxes, net investment income tax, as well as state tax. A blended average of all these, you're probably looking at 30 to 33%. Now, in the United States, the range is from 25% to about 40%. You could fall anywhere in between that. So 15 to 20%, it's probably not the tax that you're going to pay. So talk to your CPA, or if you would like, we actually have a link on our website that has that have those calculators, and you can always play around with it to see how much taxes you can potentially owe to Uncle Sam. So that's what the calculators look like. They're getting a little bit of a revamp, so may not look like that anymore. So, ladies and gentlemen, let me quickly go over the types of exchanges available to you as an investor. There used to be only one type. That's called a simultaneous exchange. You close on the property you're selling and the one you're buying on the same day. Nowadays, most of my clients will do what's called a delayed exchange, where you sell your property first and then you buy a replacement property. You have 45 days to identify, a total of 180 days to close. You also have the option of a reverse exchange. You find a property you really like before you sell, not a problem. You can buy the replacement property first before you sell your property. There's also the improvement exchange. Did you buy a property that needs a little bit of work, maybe another 100 grand, 200 grand of work? Not a problem. You can use your exchange funds to improve on that property doing the exchange. And of course, there is the reverse construction. You can buy your replacement property first, start those improvements, and still have within the 180 days the time to sell your property. I think I was going to get into, let me get into split treatment. Sorry, ladies and gentlemen, due to a little bit of notice from my city, my power might go out for the next 10 minutes anytime now. So we do have what's called split treatment. And this is what happens when you rent out a part of your property. Now, I'll give you an example. If Jason, for example, rents out 25% of his home and reports it on his tax returns, well, guess what? 25% of the value of his home can qualify for a 1031 exchange. This is another way to plan ahead for your exchange if you know how much potential taxes you may owe, right? So in this instance, Jason may know, oh, I have gains more than $500,000. And if I plan ahead, if I rent out 25% of my property, I can allocate 25% of the sales, the proceeds, the gains, and I can buy an investment property on the side. Or if he really wants to, he can contribute that 25% to his next home. As an example, let's say Jason has $1 million home. 25% of that's $250,000. Now, that means he's renting out 25% of his home, right? Jason wants to buy another primary residence instead. He buys a $2 million property because he's upgrading. Well, in this instance, he can contribute $250,000 of the exchange money towards that $2 million home, and 250 out of 2 million, that it's 12.5%. Jason needs to convert 12.5% of his home for business, investment, or trade use. He could rent out potentially one of the rooms, maybe even have a home office, totaling that 12.5%. So, ladies and gentlemen, that's what's going to set you apart when you are dealing with a 1031 exchange. If you are a real estate agent, you can use this information to help clients to identify, right, properties or parts of a property that they can 1031 exchange into, or their property that they can 1031 exchange altogether. And the reason I say this is because we're going to encounter a lot of clients who are just on the fence. They're not willing to sell. They say, hey, Wei Ming, I have a lot of profits on my property. I bought it a long time ago. I'm not going to sell if I have any taxes to pay. So by planning ahead, you can help this client not only sell their property, but they may not have to pay any taxes once they sell this property and utilize both a homeowner's exclusion and a 1031 exchange.
You lost power.
I think he lost power. I think you need to take over, Jason.
All right, then I think he's gonna probably come back, in the next couple 10 minutes. So let me talk about the commercial financing possibility for those net lease properties or any commercial real estate. So a quick introduction by myself. This is Jason Wang. I'm with Slack Capital. I'm a commercial mortgage banker. Over the past 7 years, closed so many loans, like over 300 loans and over $1.7 billion loan amount. And significant amount are the net lease properties. That includes, single tenant or actually multi-tenant units as well. Yeah, so let me just give you a quick introduction about Slack Capital. We have roughly 37 producers in Northern and Southern California, Colorado, and we recently opened up an office in Dallas. And we source all kind of a capital stack, including co-GP equity, construction loans, hard money loans, and permanent financing. All the capital sources include agency debt, all the banks, investment banks, credit union, debt funds, etc. And you can see a big list of property types, kind of covers all the commercial real estate. And over the years, it's quite interesting. Every year we do a little bit different production. So for this 2023 numbers, historically, we have been a very strong sector in the single tenant net lease space. Retail considered to be usually like 40% of our loan production. But as you have mentioned, given the buyer and seller been adjusting their expectation on the financing portion and the capital cost, so the cap rate hasn't come into agreement until recently. We're seeing the cap rate on the retail rising, and not so much in 2023. So we have a huge decrease in the retail sector, but this year we're seeing already an uptick on the transaction volume. as people are, seller willing to decrease the value or increase the cap rate. And we do loans across the country, all the major market. And for out of state transactions, most of them are single tenant net lease. So we close the, single tenant lease space. For example, we have all work with all the major, groceries, pharmacies, and, quick service and gas stations. Those are very typical single tenant lease kind of transactions, and quick service restaurants. What you're seeing here is that the transaction we did and the list of the tenant was occupying those space. Some restaurant, the wide range of restaurant, service provider, grocery, and drugstores. And over the years, I think especially, you can see on here the lender type are also varies. We have many different lender types are having different appetites for each property type. And while our specialty is actually the insurance company lender that we also service a loan for. They are typically looking at long-term strategy. They can even fix the rate up to 15 years. But obviously, those are the lenders are really suitable for long-term hold strategy. We have a client recently taking a 25-year fixed rate, given he just doesn't feel like he want to pass along the adjustment or refinance challenge with people gonna inherit his portfolio. He's like 85 years old. And we do also have the connection to bank and credit union, and debt funds and CMBS lenders. What's interesting and quite different on the commercial real estate side is the financing we're doing is mainly depend on the property cash flow. And the lender is following, very strictly on the debt service coverage ratio. And they can, on the single tenant net lease, they are relying on the long-term lease with a really good credit tenant. And so that's the situation when we considering those properties. Usually a lender doesn't want to have their long term go beyond the lease maturity date. Or if you want to design, have a property, line up the investment strategy, we want the tenant to be, staying there for at least 2 years more than the loan maturity date. And also, given the consideration of the, if you have a tenant actually kind of be rolling maturity short term, then the lender going to look at the situation, the possibility of releasing that place to another tenant and look over the market rent comps. Leverage point we're going to talk about is, as a 1031 exchange, there's quite a lot of leverage built in already. There's not many, not many people are pursuing a really high leverage since they're trying to defer their equity into the new investment. But usually a commercial real estate, they are doesn't want to go to as high leverage as a typical residential 80% loan to cost. And we have we have to estimate the loan to value at loan maturity to consider the situation, what's the potential risk of paying off the loan. And then the sponsor strength is the third kind of, I consider to be the third criteria. Usually a lender comes in, they're not going to be looking too deeply as doing those, what's this person's income, what's the W-2 income. Those are actually in the third bucket of the consideration. So if you have somebody, have a pretty strong balance sheet, the income's not that significant, that still will work with a commercial loan. If somebody have a strong balance sheet and liquidity position, they will be qualified for a commercial loan with a strong credit tenant. And then for what we're considering the commercial loan, they're just not standardized as residential. So please consult with a professional, including myself, to kind of go over whatever you experience on residential loans for 10-year, for 30-year fix or fully amortized. Those are no longer the rules for commercial real estate. And what's considered to be APR calculation, they're not so transparent in commercial real estate loans as well. So that's just just to watch out for when the lender when you're going to a bank. Sometimes they're first of all they might not be able to lend you to outside your their current coverage region. So yeah, please work with a loan broker and a commercial real estate agent to kind of find a financing source for you for your investment out of states. Lastly, I want to go over a quick chart about the the recent interest rate update we received. So for single tenant net lease, it doesn't have to be commercial real estate. There are single tenant net lease space in office and in industrial as well. And depends on the corporate. Some of the corporates have very strong. For example, you have an office building leased to Google or Amazon, then that actually serves even stronger credit than you're renting that out to a quick service restaurant. And those corporations are covering the property maintenance as well. Depends on how the lease reads. And overall, in this market, people are, the lenders are gearing towards offering good rates to multifamily considered to be safe, but also kind of not getting enough leverage. For the industrial, office, and retail, the lenders are kind of more geared towards understanding the property in place cash flow and kind of rely on that. And this, not so much on kind of in the past few years been projecting, hey, we know this one's going to be increasing a lot of the rents in the next 5 years. This is a little bit different. Yeah, so that's pretty much the end of my presentation. Do you guys have any questions?
So Jason, I think you mentioned that sales have started to slowly increase this
Yes.
year compared to last year.
Yeah,
And it's probably due to the fact that more sellers are starting to adjust their pricing.
correct. That's one reason. And secondly is the people are people are kind of in the wait and see kind of mode for the price adjustment or interest rate expectation. I think people's mindset for in 2023 was really, hey, the Fed's gonna start cutting the rate, and we will see a significant drop in the long-term interest rate and also the cap rate. So then, well, the buyer thinking the rate's gonna drop, so they're holding on to taking any financing. And the seller's feeling the rate's gonna drop, then let's not take any, let's not lower the price or raising the cap rate. However, those are actually a little bit different than the situation this year when we're seeing the Fed's probably not going to cut the rate anytime soon. Then the long-term treasury and bond yield relatively remain stable. Then at this point, people are thinking just the realization like, all right, if we wait for another year, nothing gonna change much. So they end up kind of coming to agreement, a little bit higher cap rate from sellers willing to do, and that makes more sense for the buyer. So that's how I see this more trades are happening beginning of 2024.
Got it.
Yeah,
And for like a investment deal for a commercial, I know the down payments are usually much higher than say a residential deal.
that's
So I
correct.
think it maybe explain that because there are pros and cons to getting the commercial. So it's probably a little bit easier to get into a residential, but the commercial, I think you definitely need more down payment, correct?
Right. Because of the DSCR test, I think for residential as primary residence, the main analysis is on this person's ability to repay the mortgage, and that's kind of tied to a person's income overall. However, for investment residential real estate, some lenders are even using consider the idea debt coverage service ratio loan is tied to the property income already. So I think for people having some kind of investment property, it shouldn't be a really sharp of the learning curve that's on the financing option. And for commercial, because it's strictly rely on the debt service coverage ratio, the lender's consideration is they are only considering the only source of repayment is the subject property. And then, depends on the cap rate. If you have a cap rate of property of 7 or 8 cap and the interest rate around 6%, then you can still achieve a pretty decent leverage. Maybe some lender may offer you 70 or 75% leverage. But just since recently the cap rate and property value relatively to be in the position we're in right now, there's not much room for getting higher loan amount. And this is not also this a result from I think some related to the Dodd-Frank regulation kind of back in since the great financial crisis, is that the regulators asking all the lenders to be having the buyer have more cushions into their investment, so they will act I would say with more responsibility. And I
So yeah,
saw, yeah,
I've heard from some lenders it's what, like 45% to 50%, down.
depends on the location and the cash flow. If you're
Got
buying a property with 5% cap rate and the interest rate is kind of closer to high 6 or 7, yes, then that's probably the most you can support. And in contrary, if you have buying a property with a 7% cap rate or 7.5% cap rate, then you should be able to get to the full 65% typical loan to cost. And I saw Michael has a question about the document should residential investment seller have ready when they apply for loans for single tenant net lease. I think for the documentation wise, what typically people didn't prepare is what's it called, personal financial statement, to list out all the asset and liabilities for that specific person. In a residential loan, typically you just submit a tax return W-2, and people really drill down on the income level. And for the commercial lenders, what they most, or they obviously they still interested about the income, but more importantly is to understand the balance sheet, is how much asset and liability the specific potential buyer has. And be prepared to kind of list out the liquidity, liquid asset, including bank and stock account, and the retirement account as well. That might be counted for a slight reduction because of the a person's depends on the person's age. If a person's senior, then that should be account for 100% of the liquidity. If not, then have to be counted as a discount. And the lenders look over the source of repayment. As for if there's a need to re-tenant the property, then definitely need some liquidity to do so. So the lender want the buyer or the commercial real estate borrower to have some liquidity. The rule of thumb is typically 10% of the loan amount to be remaining after closing. So in the event of any, not less likely for single tenant net lease, but for other kind of commercial real estate that requires some turnovers from the tenant, then the lender want to see that the landlords are prepared to pay the renovation and re-tenanting cost. If there's any more questions. All right, let me see if Wei Ming's back online or not. He's got a power cut off, but yeah, 1031 exchange is actually quite, we encountered that for many times. And actually Ian, for when you're doing the 1031 exchange, what's your what's your advice for kind of when to start engaging a professional about it?
Yeah, I think the earlier the better. Even before you market your property for sale, just so you have a good idea of what you like, because there's so many different types of assets out there that you really want to kind of nail down what you're comfortable with. And so, obviously, if we look at a list before you put on the market, it's not guaranteed that that property is going to be there after you close on your property. So it's a good idea to really kind of, start doing your, the research and study, what areas you like, what kind of assets you like, whether it's the, fast food type restaurants, or if it's just, like a Dollar General. Then once you kind of have that down, then when you're in contract, you can start really, really focusing on those. And, our job would be to find obviously some that might be off market. And that way, yeah, you'll be ready and feel a lot more comfortable. And then that way you won't be in this time crunch with the, identifying these properties.
Yeah, and I saw answer from Jen. So yeah, you should be able to unmute yourself and join the discussion.
Yes, hi. I have some questions. Number one, I want to know, so you have some comparison between the residential as well as the single tenant commercial. It looks really good for the single tenant commercial in terms of the return. I wonder whether you have any data regarding the vacancy rate. That's the question number one. Number two is that what do you think about the trend of the commercial? For example, now I'm doing residential. I'm thinking about diversifying, but I'm concerned about the future of the commercial. For example, the office is impacted by the work from home trend. The retail is impacted by the online like Amazon, etc. Even for the restaurant, like the DoorDash and many groups that deliver food, also impact some restaurant. So I want to know, what do you think about the future of the real estate, where the growth areas are? Thank you.
Yeah, it's interesting. Well, I just attended a big retail symposium, and it's, the retail market right now, if you look at it from the past 20 years since I started, and if you look at the retail market, it is like, it's never done like what office has done, where it's just gone crazy up and then crazy down. It's always been very steady, and it's always been growing. And, as we know, as real estate professionals, location, location, location is always key. And it doesn't mean that you have to be in Beverly Hills. It doesn't mean you have to be in Los Gatos. You could be in, you know, in Oakland, you could be in Antioch, but in a good location in those cities make a huge, huge difference. And so the future, I think right now, I don't think, I think still people want to have those experiences of going out and eating and stuff. I don't think, everyone's ever going to be like, we're 100% going to stay at home and just order food every day. I think there's a huge social connection that people still want and need. And so I feel like there's definitely a need for I think retail will always kind of be there. Office, I would definitely stay away from right now. But you know what? Medical offices are always good. I feel like medical, dentists, optometrists, I mean, all those I think are pretty good. Drugstores, I don't know. I personally don't like drugstores. I feel like that any day can be an online thing. And so yeah, so industrials actually also really well. You talked about the whole Amazon effect there, because of Amazon, all the industrial spaces are doing very, very well. Rents are I think at its highest, vacancies at its lowest. So yeah, I would, so I think the future is that, I'm sure the office market will somehow come back. I just don't know to what extent, and it might take a lot longer than we expect. But for retail, I mean, do a fast food near a university, right? Universities never shut down. If you're close to a big university, I mean that's a huge, just a huge generator of people that live in the area, with all the students and the faculties and everything. Even hospitals. My family, they're actually a hotel developer, and that's what one of the things that we always looked into were, being by these big, producing like employee generating companies. So, universities, hospitals, all these kind of, yeah, these are the kind of the areas where you kind of want to look at.
And adding to that is for office, there are actually some sub-market performing really well as reaching like full occupancy rate. For example, Culver City in the Los Angeles market is kind of basically a full occupancy compared to like Los Angeles downtown. So then it's just office has tend to be kind of geared towards smaller spaces, and people want to go to the office closer to where they live, not going driving like stuck in traffic for 1 hour to a downtown area anymore. Similar in the Bay Area, you see the occupancy rate in Walnut Creek and Concord is probably much better than Oakland downtown or San Francisco downtown. So office is definitely I think is tough, but there are opportunities. But location is very important. Retail wise is in the challenge for the big box retail has been actually the bad Amazon situation is since 2016 people are talking about the big box retail is dying. But is retail dying? Not really. It's kind of they're changing the plans into more experienced oriented retail. For example, restaurant and even movie theaters kind of back nowadays. The movie theater is a little bit risky today, given kind of what people experienced during COVID. Um, but retail just the space are limited. There are not much retail space out there, but people still need a place to social and gathering. And then there are a lot of developers are having very creative idea how to regenerate the power for retail center. And in addition to the for people considering the return for residential, there are definitely returns in there. But people are the returns are two things: the value increase for the future, because you're bearing the carrying cost, or the current cash flow, and that's a balance you have to consider in today's market when you can put your money into savings with 4% interest rate. Was it still worth paying the carrying cost on the residential property if the increase on the price is kind of limited? I did my calculation for my own home. I was thinking, hey, I'm basically paying roughly 6% carrying costs, including mortgages, property tax, HOA fees, and insurance. And the home price has to raise more than that to make sense than whether I'm selling now. That's in my calculation. And for the residential, there's also two components. Is one, you're not buying just, it's a combination of leisure enjoyment and also investment. And how much weight you're on each. I think residential now is on the investment side is considered to be lower and lower of the weight and more on the leisure side. So I think that should be in the consideration whether or not to make any changes or any transaction on your real estate portfolio.
Thank you. Thank you.
Let me see if there's any more questions from anybody. I don't know if Wim is gonna join us back. Seems like PG is giving him a hard time.
So Wei Ming is actually doing a deal for us right now, and yeah, he's been great. And as a 1031 accommodator, he's been on top of everything. As well as Jason. Jason has done deals for us as well before. So everyone that's kind of in this presentation, we've all worked with each other, and it's all been very successful. So I think if anyone has any questions regarding lending or 1031s, yeah, feel free to reach out, and we will definitely have answers.
Yeah, and thank you for joining the our webinar, and then for the folks register on website, we'll send over the slides and the meeting recordings afterwards. We'll also post this on our website so people can access it later.
Actually, I had a question. I know Dexter is on is watching. Dexter, are you there?
Yep, I'm here.
Hey, how are you?
I'm good. I'm good. How are you guys?
Good, good. So I see you. I mean, obviously Dexter's a big residential agent in over there in the East Bay. Where do you see? Have you seen investors that have single family homes entertain these kind of opportunities, or what's their feel? It'd be interesting to hear from like a residential agent.
I just had a listing that went pending. It's a fixer upper, right? So, um, we listed it it's a good neighbor. It's an all right neighborhood. It's in Hayward, and we listed it for 699. And some of the comps after remodel and everything, we're seeing about 850 to about 900, depending on what you do to the house, right? Or if you add a bathroom or stuff, you can even go up higher. And we got 16 offers, and I would say 80% of them are investors, flippers, right? I think, yeah, 80%, and 20% were end users for the property. The end users were bidding higher than the investors because the investors are looking for their margins. And what I noticed in this past 2 weeks since I marketed it, I've probably got 100 calls on it. Our investors are really looking for, off market deals because they're asking me, hey, is there anything else? Because once it hits the market determines the price, right? So, and usually better um, for the seller because the market dictates the price and what it'll go for. But I see tons and tons of cash investors out there, and they're using hard money or whatever to do this flip. This is my, I think, my in the last 2 years, probably my fourth or put in the market. And I get a text every week, if not every other day, from an investor saying, hey, do you have any off market deals? The way they're doing it, and I'm seeing it, is if they make about, on a given deal under $1 million, if they make $100,000 to about $200,000 on a deal, they're doing well. And that's what kind of their target frame, time frame is. There's new laws coming up, I think in July, that is it July, regarding when you're flipping a property. Now you have to disclose the contractors you use and all the receipts and things like that. I haven't really checked into it. I just heard from my contractors that I use that today, hey, this is coming about. So if you're flipping a property, check on this new laws that's coming about. That, and a lot of my investors slash friends who are doing this saying that this might be changing the
Mm,
landscape for a lot of the flip going to be able to use their handymans or whatever. There's going to be more transparency for the buyers buying this house. So probably better for the consumers, but less margins for the flippers out there because of what's going to happen in the new law. So I think it comes about in July, and that's why a lot of people are rushing to do some flips and get it out and back in the market before that deadline and such. So a lot of things happening. There's still opportunities out there. You'll probably see a lot of people. Oh, you always see something commercials or on Facebook say, "Hey, I buy houses cash." They're just trying to do it, to flip it and turn around, make $100,000, $200,000. And I've seen people, some of my people that I know have actually lost money doing that. Another big thing they're doing now is, because of a new law, is they'll take a land. If it's big enough land, they'll subdivide it and put multiple units in it and then sell each parcel differently because there's a new law. They want to increase housing in the Bay Area, in California. So that's what I'm seeing. So they're approaching sellers or people who are not selling yet. They've been in the house for a while, and that's where the opportunity is finding a seller who's, or somebody who's just tired. They want to move on with their life, and they're sometimes partnering up with them, doing co-op, saying, hey, we'll do this project with you and we'll put 2 or 3 houses in your house. And then, if you sell your house, and then there's a lot of opportunities you can do there, but it's just finding the right property out there at the right price. A lot of number crunching to make work. So, but if you hear somebody who's, the one I'm doing right now is it's not a probate, but it's a trust. Usually when it's change of hands, and what I'm seeing is this was a rental before, because of the laws, they're not they don't want the kids don't want to rent, right? So end of life of the parents, and they're now inheriting the properties. They're now saying, hey, we just want to get rid of the property. So uh, like that, there could be opportunities in residential real estate. That's pretty good.
Thanks, Dexter. Hey, Wei Ming is actually back. Wei Ming, do we want to just have Wei Ming kind of close it out?
Yeah.
Yeah, sorry about that, everybody.
Let me get back to your slides and just kind of get you the control to
Yes,
finish.
sir. Yes, sir. So sorry about that, everybody. So what I was actually trying to get into is really talk about the unique strategies about a 1031 exchange. What we have here in front of you is what we call a split treatment. This happens when a investor is renting out or using a part of their property that has been used for business, investment, or trade use for a 1031 exchange. And I think I was mentioning earlier, what if Jason had 25% of his home rented out? And it doesn't have to be completely rented out. It could be 15% rental, maybe a 10% for office use. All right, that portion of the property, it can be 1031 exchanged. So by planning ahead, talk to your CPA, find out how much capital gains you have on your property. If you're a realtor, this is something that it's going to motivate that client to sell. And what I mean by that is, let's say you have over that $500,000 of capital gain, right? And if you're married, you can only take up to 500,000. Anything beyond that, you're going to have to pay taxes on. There's no way around it. But by planning ahead and just working out the numbers, I've had a lot of clients who found out, oh, maybe they need to rent out 20% of their home, 25%, whatever that number might be. They do it for a year or two before they sell the property. And then when the time comes, they'll just do a 1031 exchange on that portion. So that way they walk out of that completely tax free, right? Homeowners exclusion taken and 1031 exchange taken as well. This is also a great strategy for a lot of investors who might be looking to downsize. Maybe Jason's looking to downsize. He's not looking to buy a $2 million home. What if he wants to buy a home for 750,000, right? And he might very well do so. Downsize to 750 and that 250,000 from the 1031 exchange. He can buy an investment property on the side. Get him that passive income when he's in retirement, right? That might be the reason why he's looking to downsize in this example. So there's a lot of uses for 1031 exchange, and being able to identify what works and what doesn't work, it's going to set you apart, especially if you're a realtor, right? You can identify what can be 1031 exchange, what cannot be 1031 exchange, instead of just saying, oh, yeah, you got taxes to pay. So that's what I was initially trying to get at. People also often ask Wei Ming, how does Uncle Sam know what I'm doing? Well, once you finish your exchange, you do have to file this form 8824. The one thing that you want to ask yourself when you're doing a 1031 exchange, I sold property. Did I buy enough to satisfy my exchange requirement? It doesn't matter if you're buying with a third party, doesn't matter if you're not on the loan, doesn't matter where the money comes from. The government is asking, how much did you sell? How much did you buy? So that way they know how to tax you. And this is the form that gives them a summary of the whole thing. So sorry about that, ladies and gentlemen. Little bit of a mishap earlier, but am I opening up for questions right now?
Yes. I have a question, Wei Ming. So for the Form 8824, so is it the property is being bought as higher cost than the original? You won't get you're already getting deferred capital gain tax, or what's the rule here?
Absolutely. So what you're referring to is how much property do I need to buy in order to defer all my taxes? A lot of people will hear, if I sell for $1 million, I need to buy for $1 million. Here's the true answer. The true number is your net sales price, your $1 million sales price minus the closing costs, agent commission, escrow fees, transfer tax, and recording fees. Now, on $1 million sale, that could be what, $60,000, maybe a little more. That could be the difference in the loan that your client takes out. That's a big difference, $60,000, right? Being able to afford the next property or not. Now, if we're talking commercial properties, multiply that number by 3, by 4, right? You're looking at $3-4 million sale. That closing cost is going to be much higher. That's over $200,000 potentially, right? And $200,000 is a big difference when you're making offers as well. So again, the true number is the net sales price, to answer your question.
Got it. Thank you. And I have another one regarding reverse exchange. Is how I have heard some of our colleagues mentioning, if your reverse exchange, I thought it's gonna be has to be purchased all cash. And then if taking a loan, that it cannot be signed by the exchange buyer. So I'm kind of trying to understand if there's any financing available for reverse exchange will not trigger the penalty.
Yeah, so what you're talking about is how does a loan work with a reverse exchange, essentially, right? So here, I'll give you a brief summary of what a reverse exchange structure is going to look like. Number one, we will create an LLC, and the LLC buys the replacement property on the behalf of the client. Where's the money coming from? Well, the client is essentially loaning the money to the LLC in order for it to buy that property. Once the client sells their old property, the new property with the LLC is transferred to the client. Now, with a lot of conventional banks or conventional lenders, they'll say, Wei Ming's client, I'm not lending you money if Wei Ming's the one that's on title doing this transaction. So in order for you to be able to come up with an all cash offer, if you really don't have all cash, you're going to need a private loan, a bridge loan, or a hard money loan. Basically the same thing, right? So non-recourse loans.
Okay.
That's what we need.
Got it.
Wei Ming, I have a question regarding the reverse exchange. After, like, we need to create a LLC, and after we close the transaction, is there any issue? Is the owner still need to maintain the LLC?
Well, we create the LLC for the sole purpose of the 1031 exchange. We're not going to hold the new property under our company's name, right? We don't want to mixing it with any asset. That's the whole purpose. For our protection, for your protection. The LLC buys the replacement property. Again, once you sell your old one, we will transfer the new property with the LLC to you. Now, it's already paid for that year. The LLC is already paid for. Whatever you decide to do with that LLC later on, that's up to you. You want to get rid of it and just take the property out, that's fine. You want to keep that LLC, that's fine. The way we typically name the LLC is we name it after the street of the sale property.
Okay, thank you. So if we want to keep the LLC, that means we need to file the tax return every year.
Yes.
Okay, thank you.
And Dexter, you had a question for Wei Ming?
Hey, Wei Ming, do people still do super 1031 exchange where, let's say I have a property where it's a single family residence, right? And I've been renting it for a while, 1031 it to a new property, and then I rent it out for a year or whatever, how many minimum that is. Then I move into that property for 2 years. Do I get my $500,000 exclusion? Is that still working? I know some people, we used to do that, or some of my clients
Yes,
used to do that. So
a lot of people did that prior to 2009, but there was a change in 2009, and the change is a proration. You get a proration of that $500,000. It's the number of years you've lived in the property out of the number of years you've owned it, and you multiply that by your gains. I'll give you an example. Let's say you rent your property out for 2 years, you move out, live in it for 3 years. 3 out of the 5 years that you've owned this property, in those 5 years, sorry, in those 5 years, let's say it went up by $500,000, right? A lot of people are thinking, oh, I live in this property now. When I sell it, I take my homeowner's exclusion, 500,000, right? Most people would think that. It's prorated, meaning you live in 3 out of the 5 years, that's 60%. 60% of the 500,000 is excluded. So that means it's only 300,000 you're taking. The other 200,000 you have to pay taxes on. And your previous 1031 exchanges that you defer taxes, those come due because you're now selling the property, cashing out, and not doing another exchange, which you can't do an exchange on a primary anyways. So not only are you paying taxes on that $200,000, but also all the previous transactions leading up to it for your 1031.
okay, what if you lived in it for, let's say, 10 years?
Well,
Eventually became your, yeah.
yeah, so let me do a quick calculation. So you rent out for 2 years, you live in it for 10. 10 out of 12 is 83%. 83%, and let's say it only goes up in value by 500,000 again. That's 416,000 and change. You're not taking the full 500. It's prorated. But if it goes up by $1 million, then yeah, your percentage is going to be higher. But in my case, in my example, if it only goes up in value by 500,000 in the last 12 years, yeah, then you're not taking the full 500.
Got it. Okay, thank you.
Yeah, absolutely. Do we have any more questions?
I also have a question regarding the commercial investment. What do you think about multi-family market? Or what do you think about compared to all different types of commercial property? Like which kind of property you would recommend? Or maybe have the best cap rate right now?
Well, the best cap rate, yeah, multifamily cap rate's still it's always a little bit lower than the commercial. The good thing with residential multifamily is that it's obviously quicker to rent out. So that is actually one of the benefits of multifamily. If you have a vacancy, typically you can rent that out within, I don't know, 2 weeks to a month. Commercial is different though. Commercial, if you have a vacancy, that could be 2 months to a year to get that leased out. So that is a huge, that's why you really want to look at the kind of property you're buying. The big box retailers like the Best Buys or something like that, or even say like a CVS or a Rite Aid. Like there's one on the corner of Stevens Creek and De Anza. Oh no, Homestead and De Anza right now. A Rite Aid just moved out. It's been on the market for at least 6 months right now, and I don't think it's that's a very difficult space to lease, even though it's in a great location. Who's which retailer is looking for 8,000 square foot right now? And so that's where you kind of want to, ideally, I think you want to look at retail with smaller footprint size. And that's probably where you kind of want to look. But multifamily, cap rates are lower, but again, then you still have the headaches of, we have a client right now, he has a multifamily in Hayward, and he is just battling the tenant right laws over in Hayward right now are incredible. And he's actually he's gonna sell those because he just doesn't want to deal with them. And so again, you're dealing with the tenant right laws, you're dealing with, even though he has a management company, you're still dealing with a lot of like different types of issues.
Yeah, in my opinion, for multifamily, I think the most important thing is property management. And if you can identify, someone with a really good property management, it'll be a good idea to invest with them. And for commercial, including retail, office, industrial, I think the most important thing is leasing. So how you kind of, stagger or strategize to bring the best tenant into the building and to maintain those tenants, on the leasing perspective. And the other sector, thing I want to mention is for the return, is the cap rate. What I consider the true return for real estate investment is the cap rate plus rent growth or NOI growth. In the past, residential or multifamily has a really significant rent growth year over year. Then your true return is actually, those two numbers combined. But since nowadays, the rent growth on the multifamily are actually slowed down, or then everybody's expecting the rent growth to be relatively flat, then the cap rate should be justified to, if you're consider 2% increase, then if you're still buying a multifamily at a 2.5%, 3% cap rate, then the return doesn't make much sense in my opinion. But if you have buying a multifamily for a 3% cap rate, but you're expecting rent growth for 5 or 7%, then yeah, your true returns are gonna be 12, 13%. Then that's still a good investment.
Thank you very much.
Wei Ming, what about, I don't know if you talked about this or I might have missed it. Can you use I have some clients, they use REITs as to park their 1031s because they couldn't find their property or the property fell through. What's your view on those?
Actually, a 1031 exchange cannot get into a REIT. The only time that can work is what's called an UPREIT. UPREIT occurs when the REIT is buying your property in exchange for shares of that REIT. So that only happens if you're selling commercial property, and with a REIT buying your commercial property, chances of that are pretty low of it really happening. If you want to get into a REIT type of ownership, your closest bet would either be a triple net property or a Delaware statutory trust, which I believe Yuan had on his slides.
Yeah, DST was kind of a little bit different. Is some of the operators in different areas are kind of offering this for people to subscribe and park their 1031 exchange money. But by doing that is kind of, I think the key is usually people are doing that for kind of like a last resort when they couldn't able to meet up the timeline. They have to put something in there to kind of to avoid paying the capital gain tax. But there are also challenges with the DST is that you have to kind of follow through whatever the kind of issuer is doing. Usually there are like large multifamily portfolio in different area in the country. You just have to study, whoever's the creator of the DST, they, look over their profile and see they're a, good operator.
Yeah, that's what some of my clients are doing. They're going to park their money on DSTs and they're buying pools of multifamily real estate in the US, right? And they pull their money together to buy that. So
yeah, but then you're losing you're having less control. Like when the DST, they if the developer or operator decide to kind of sell the property, then you're kind of forced to go through another 1031 exchange.
yeah, but it's just a way to, but they have some of them have exit strategies, 1 or
Okay.
2 years, so that you can unpark your money, you know,
Right.
in 1 or 2 years. So
Right.
it depends how it's written. Yeah. So okay, just I wanted to see what was the view on that.
All right. I think that's it. Yeah, thank you so much for everybody to join. And I'll, as I mentioned, I will kind of publish the recording and the slides and share with the participants in this meeting. All right, thank you so much. We'll keep you posted on the next CREA events.
I have last question for Yuan. I have
Okay.
a last question for Yuan.
Okay.
Yuan, what's the industrial cap rate in Bay Area right now?
For industrial?
Yeah.
Industrial right now? Oh, geez. I don't see too many of those around, but I'm guessing it's probably what, like
6?
Yeah,
5.5?
5.5 to 6% maybe.
Okay.
It just depends on who the tenant is, really. Yeah. Again, there's so many factors that go into that.
I understand. I'm just need a range. Thank you. Thanks. Okay.
Hey, Yan,
Thank you.
I have a quick question too.
Yeah.
Are you seeing any data centers in the Bay Area? People
For
wanting
sale?
data centers? Yeah,
Uh,
or is there activity? What's the activity on data centers in the Bay Area?
I mean, I think they're pretty active. They want to build. A lot of data centers want to build and be in buildings, but I think the city, it's very hard for the cities. I think it's because they take so much power. So to get that approved is really, really difficult.
I see.
It's
Got
like
it.
people,
Okay.
industrial people like distribution center, but but the investor loves it, but city hates it.
Yeah, yeah.
That's good. I didn't think about that. That's a good. Thank you. Yeah.
All right, guys.
All
Well,
right.
thanks.
Thank
Thanks,
you. Great
everyone.
meeting. Thank you.
Thank you, everyone.
Okay.
All right. Thanks, guys.